Welcome to the channel. Today, we're diving into one of the most important economic tools that controls your money, the federal funds rate. You've likely heard about it, but do you really understand how it works? In this video, we'll break down everything you need to know, including how it affects your savings, loans, investments, and the overall economy. Let's get started. First things first, what exactly is the federal funds rate? Simply put, it's the interest rate at which banks lend to each other overnight. It may seem like a minor detail, but this rate has a huge ripple effect throughout the economy. Think of it as the cost of money for banks. When this rate rises or falls, it influences the cost of borrowing for businesses and consumers. But here's the kicker: this rate doesn't just affect banks, it impacts you directly. Now, you might be wondering, why should you care about a rate that only affects banks? Well, the federal funds rate directly influences inflation, employment, and economic growth. When the Federal Reserve changes this rate, they are trying to manage the economy. Higher rates make borrowing more expensive, which slows down consumer spending and business investments. If the economy is slowing down too much, like during a recession, the Fed might lower the rate to encourage borrowing and spending, thus stimulating growth. So, how does all this affect you? If you have a savings account, the federal funds rate can impact your interest rates. When the Fed raises the rate, banks typically offer higher returns on savings accounts, CDs, and money market funds. For savers, this is a positive development. Conversely, when the rate is lowered, interest on savings accounts usually drops. For borrowers, the effects can be significant. Higher federal funds rates mean higher interest rates on mortgages, car loans, credit cards, and even student loans. Now let's talk about one of the most important impacts, the stock market. When the federal funds rate rises, borrowing becomes more expensive for companies. This often causes a drop in stock prices, especially for growth stocks. On the flip side, when rates are lowered, borrowing becomes cheaper for businesses, which can lead to stock market growth. Real estate is another market deeply affected by the federal funds rate. When rates rise, mortgage rates climb, which can make it harder for potential buyers to afford homes. This tends to cool down the housing market and lower home prices. But when rates fall, mortgage rates decrease, making home loans more affordable. So, how can you make the federal funds rate work for you? Whether you're an investor, a saver, or a borrower, understanding how the Fed's decisions affect the economy is key to making smart financial choices. First, if you're an investor, consider diversifying your portfolio to hedge against rate changes. Next, for those with large amounts of debt, higher rates might mean it's time to pay down loans faster. Finally, for savers, consider locking in higher rates with CDs or money market accounts before rates drop. If you're looking to buy a home, you may want to act quickly when rates are low. So, what does the future hold for the federal funds rate? The Fed is always adjusting the rate based on economic conditions. Keeping an eye on these changes is critical to making informed financial decisions. Now that you understand how the federal funds rate impacts your finances, it's time to take action. Stay informed and make smarter financial decisions by subscribing to our channel for more expert insights. Don't forget to like, comment, and share this video with anyone who needs to know about the federal funds rate. Thanks for watching.